What is going on, guys? What is going on? Good to see everybody. It's been a while. I don't know. When was the last time we streamed? A week ago? 2 weeks ago? I can't even remember right now. But let's see what's going on in the chat. Just waiting for our Uncle Jerome to start speaking. This is I guess it's the Wall Street Journal Future of Everything event, which is, an event with a bunch of speakers. So it's not a Fed event. So for those of you thinking that this is an official FOMC meeting, it is not. However, obviously everything that comes out of Jerome Powell's mouth, especially now, is going to be significant. So, we're going to be getting some commentary from Jerome Powell on the future of inflation. They will probably ask him about rates, and he will probably be very cryptic about how many basis points they're going to raise the rates by. We can see actually what the FOMC watch tool. We could see what they're projecting. Right now, we have about a 91.3% chance that we will get a federal funds rate of 125 to 150 basis points. So right now we're at around 75 basis points. 75 to 100 basis points. So we're only expecting the Fed to really raise rates by 50 basis points. And this is based on the futures, right? The future, basically bets that investors are making or traders are making of what the Fed will do. So this represents sentiment pretty accurately. It hasn't been off throughout this whole rate hike cycle. So I don't think anyone is expecting 75 basis points. And then yesterday on my video, I covered that Bullard, and Bullard is considered one of the more bullish FOMC members, Fed members, was saying, he was saying that 75 basis points is off the table. So, if the most bullish member is saying that, then I have to think that the max we're going to see for the next rate hike is going to be 50 basis points. Could even be 25, depending on how bad the recession fears are. And right now, obviously, we've had 1 quarter officially of negative GDP growth. If we have 2, we will enter into official recession status. Although the extent of a recession is not always, it's never really known, but the extent of a recession is just as important. So if we have what's called a shallow recession, it doesn't mean that every recession is going to look like 2008 or 1929, right? It could be a very shallow recession. The COVID 2020 recession was a shallow recession, and you know that from March until basically it only lasted 30 days or so before the stock market was roaring again, and then it took a couple of months before it was back to all-time highs, and then another couple of months before it just completely went haywire. So yeah, again, still for those that are just joining, still waiting on Jerome Powell to speak. We have the video on the Wall Street Journal channel live, just waiting for him to, I don't know if he's in a bathroom break or something. With that said, let me take some of your questions, say hi to some of you. Obviously, the donate button is still there. That goes 100% to St. Jude's. So be sure to crush that. If you feel like giving any amount of money to me, don't send it to St. Jude's and then ask your question. Mr. Ether Robert Warner, who always comments on the videos and is also an active member of the Discord, thank you so much for your $20 donation. All right. Let me know, by the way, if you guys can hear the video well.
Welcome, Chair Powell. Thank you so much for joining us this afternoon.
Thank you, Nick. It's a pleasure to be here.
And I want to welcome our audience watching along on WSJ.com, Twitter, and YouTube. So, Chair Powell, let's get started. 2 years ago, you acted very quickly and decisively. You did things that Fed chairs straight up have not done, given the emergency of the pandemic. Now, I hear a lot today, especially from our readers. They look at the economy, they look at how high inflation is, and they look at the state of monetary policy, and they say the Fed is not reacting with the same urgency. What do you say to people who say that you are not treating high inflation today like an emergency?
Well, I guess I would start by saying this, Nick, that we know that this is a time for us to be tightly focused on the path ahead and on getting inflation back down to 2%. We know how people are suffering from high inflation, and we have both the tools and the resolve to get inflation back down. And no one should doubt our resolve in doing that. And I think if you look at how quickly we've moved in the last few months, really, then you'll see that financial conditions have tightened quite a bit. What we need to see is inflation coming down in a clear and convincing way, and we're going to keep pushing until we see that.
So to get into some of those tactics, the Fed raised interest rates at its last meeting by a 0.5 percentage point. That is something the Fed hadn't done since 2000. And you've said that you think the Fed may need to do that again at your next 2 meetings. Why are you being so specific? Doesn't that limit your options?
Well, I didn't say, so we make the decisions at the meetings. What I said was a couple things. First, I said that we decided to raise the federal funds rate, range for the federal funds rate by 50 basis points at the last meeting. We also said that we thought ongoing rate increases would be appropriate. And during the course of the meeting, it became clear that there was very broad support on the committee for having on the table the idea of doing additional rate increases of that magnitude at each of the next 2 meetings. And that's what I said. And that's short of a prediction or a statement or forward guidance that we're actually going to do this. But I would say if the economy performs about as we expect, then that's something that'll be on the table. And honestly, it's so things are so uncertain in the economy right now. It's very difficult to think about trying to give guidance out into the future. We don't know the path of the economy. There are many global events going on that can affect that are really not under our control as well.
So if the base case is to do a 0.5 point at the next 2 meetings, why not just do a percentage point at your next meeting, rip the Band-Aid off?
Well, as you know, inflation works through, monetary policy works through expectations. So markets are pricing in a series of rate hikes, a significant series of future rate hikes, amounting to already having done that. So we like to work through expectations, and I'm not blessing any particular day's readings, but it's been good to see financial markets reacting in advance based on the way we're speaking about the economy. And the consequence, as I mentioned, is that financial conditions overall have tightened significantly. I think if you broadly across financial conditions, you're seeing that, and that's what we need. What we need is to see really growth moving down from the very high levels that we saw last year, moving down to a level that's still positive, but that will give the supply side a chance to catch up and a chance for inflation to come down as we get supply and demand back back together.
A couple years ago, you talked about moving slowly when you're in a dark room, when the lights go out. Obviously, things are different now. It's harder to do that. You're moving in much faster increments as you raise the price of overnight money. But I wonder, as you look ahead, what are you going to be looking for to determine whether to increase that pace of 0.5 percentage point increases, say, to 0.75 point, or to slow things down to the 0.25 point increment by which the Fed has raised interest rates more often over the last couple of decades?
So I do think, by the standards of central bank practice in recent decades, we're moving about as fast as we've moved in several decades. But I guess the way I would say it is this. What we need to see is clear and convincing evidence that inflation pressures are abating and inflation is coming down. And if we don't see that, then we'll have to consider moving more aggressively. If we do see that, then we can consider moving to a slower pace. And it's going to be a judgment call that we make going forward as we carefully monitor incoming data, the evolving outlook. How are financial conditions changing? How are they affecting the economy? And that's how I think about it.
So back in 2016, you were a governor of the Fed, and in late 2018, you were chair of the Fed. There was a significant tightening in financial conditions. There were some global growth shocks. Global growth was slowing, and the Fed pulled back from its plans to raise rates maybe as aggressively as would have been the case before all of that happened. With the global shocks that we're facing now, the recent tightening in financial conditions that we're seeing now, What would you need to see on that side of the markets to reassess the pace of rate increases right now?
You know, the underlying strength of the U.S. economy is really good right now. The U.S. economy is strong. The labor market is extremely strong. Growth this year has been marked down, but is still at very healthy levels. So you saw today's retail sales number. The economy is strong. The consumer balance sheets are healthy. Businesses are healthy. The banks are well capitalized. So this is a strong economy, and we think it's well positioned to withstand less accommodative monetary policy, tighter monetary policy. Of course, we do monitor global events, and global events have been very important drivers of economic conditions lately. The war in Ukraine is something that has upset the global commodity picture, while also threatening the global order more broadly. And the rolling shutdowns in China are still going on, and those are having an effect on global supply chains, of course. So we watch those things. We watch how they affect the U.S. economy. The effects are very uncertain. They probably weigh on growth, downward on growth, and probably push inflation up at the margin. But even through all that, we see the U.S. economy continuing to show real strength and be well positioned to handle the policy changes that we're making.
Chair Powell, a number of your former colleagues, Richard Clarida, who was vice chair until this past January, Bill Dudley, the former New York Fed president, have said recently that they think that the Fed is going to have to raise its short-term policy rate to 3.5%, maybe 4%, maybe higher. How are you thinking about the destination right now for how high you might have to raise interest rates?
So as a policymaker, the way I'm thinking about it is that right now we're raising rates expeditiously to what we've been saying, to a more normal level, which is something that we'll reach maybe in the fourth quarter. But it's not a stopping point. It's not a looking around point. We don't know with any confidence where neutral is. We don't know where tight is. We just don't, and particularly in this environment of higher inflation and very strong growth and a really tight labor market. So what we're going to be looking at, meeting by meeting, data reading by data reading, is what's happening with financial conditions and what's happening with the economy. Really, what effects are our changes in policy having on the economy? Are we starting to see what we need to see, which is a really clear and convincing evidence that inflation is coming down? That's what we really need to see. So we'll be watching for that. If that involves moving past, broadly understood levels of neutral, we won't hesitate at all to do that. We won't. And honestly, we will go until we feel like we're at a place where we can say, yes, financial conditions are in an appropriate place. We see inflation coming down. We'll go to that point, and there won't be any hesitation about that.
Just as it can be hard for you to know when to stop raising interest rates, it can be hard to know when to start. And obviously, these things look blindingly obvious in hindsight. But I want to go back to last year and ask you, what went wrong last year from a policy perspective? Again, with the benefit of hindsight, knowing things now that you didn't know then, what do you wish you had done differently last year?
So we have to make these decisions, and we do make them in real time based on what we know at the time. And so I would say, if you replay last summer, we had a real spike in inflation that began in March, April, May, June of last year. And then inflation came down month after month after month for about 4 months, anyway, through the end of the summer. So we were concerned because we saw inflation spreading more broadly, and because we didn't see supply chain issues improving. We didn't see labor force participation improving. So we had real concerns. But still, the incoming inflation data were kind of consistent with our story. And then the data really changed, pretty thoroughly beginning in October, and we responded very much to that. So since then, we pivoted in our policy, and since then you've seen really quite significant tightening in financial conditions. I don't know that financial conditions have tightened more quickly than this in a very long time. And but that's what happened. And I've said, and I've said for the last 2.5 months, I've been saying that if you look back in hindsight, give yourself 20/20 hindsight, then yes, it probably would have been better to have raised rates earlier. We were looking at some weak employment reports. We were looking at inflation reports that were coming down. When that stopped, and when the data started pointing toward a stronger economy with higher inflationary pressures, higher wage pressures, we didn't hesitate. From that point, we've really moved. I would say almost expeditiously. Since then, we have moved, and you see where we are 6 months later since that happened. You now have the 10 years up, 140 basis points. The 2 years up almost 200 basis points, and the 2-year Treasury is a pretty good measure of policy expectations. So quite a lot of tightening, and appropriately so. Inflation is way too high, and we need to bring it down, and we're going to use our tools to do that.
Obviously, the pandemic has made economic forecasting more difficult than it's been in a long time, and I wouldn't presume to think that it's easy. But looking at demand last year, the fiscal stimulus that was approved by the administration and Congress last March, it was far larger than what your own economists at the Fed were anticipating. Did that end up putting the Fed behind the curve in terms of you just didn't judge demand properly because of the much larger stimulus that was approved?
So it's really not our role in economic policy within the government to reach judgments on economic actions taken by Congress or by the administration. There are other parts of the government that do that exact thing, but it's really us. So I guess I would say that there was a lot of stimulus put behind the U.S. economy. That was both monetary policy and that was fiscal policy. But still, you can't get the kind of inflation that we've gotten out of that much demand. That was a lot of support for demand. You can't get the kind of inflation we have without these supply bottlenecks that we've had, and that includes the supply chain problems that we've had and the shortages. If you look at automobiles, that's a great case. Ordinarily, car makers would have just made more cars. There was tremendous demand for cars, but for really idiosyncratic set of reasons, there weren't enough semiconductors, so there aren't cars, and so you have tremendous vehicle inflation. That's just one example. Same thing, we didn't see. We had a real hit to labor force participation. We didn't see that coming, and so really these supply side factors, you have to add them in to any kind of economic model to get the kind of inflation that we have. We clearly had very strong demand, and we knew that. What we didn't know and anticipate was how large the supply side effects would be and how persistent they were. And we now know that in hindsight, and we see how sticky they are. And so, as I've mentioned, we're not setting policy on the expectation that we get relief on the supply side until we actually do.
All right, so that was 2021. Then comes along 3 months ago, the war in Ukraine, which has obviously been enormously disruptive to millions of people in Eastern Europe, but also has had a profound effect on energy markets, commodity markets, and we also have new lockdowns in China. How have those events changed the difficulty of what it is that you are trying to do?
Well, I mean, clearly they've raised the degree of difficulty more importantly, for the people around the world who are looking to have a continued expansion in the economy, but also for us from the standpoint of policy. So, the war in Ukraine is pushing up commodity prices for both food and energy. And we don't really know how long that's going to last now. It might have thought at the beginning, and we don't make those kind of judgments, that it wouldn't be long lasting. Now it looks like it may be, so that may be a persistent effect. Same thing with the rolling shutdowns in China. They won't last forever, but they'll last for some time, and they're having an effect too. And what they're doing is they're preventing any healing of supply chain problems. So that's going to make it harder for inflation to come down. And so really they've added to the degree of difficulty to what was already a challenging project.
So we heard here before lunch from Barry Biffle, the CEO of Frontier Airlines. he says he's raising prices because of fuel costs, and there's a pilot shortage. And now those are things outside of your control. But you said just now that the Fed can no longer set policy on the hope or expectation that supply chains will give you a lot of help here. So what does that mean for Fed policy? If these things are out of your control in the supply chain, or if energy markets don't improve anytime soon, what is the implication of that for policy?
Well, it doesn't have much of an implication in the near term because we clearly have a job to do on demand. So, there is an imbalance in the economy broadly between demand and supply. And so we can't really affect supply. The things that are really supply side issues, our policies don't work on those. But we have a job to do on demand. And I would, for example, point to the labor market where there's more demand for workers than there are people available to work by a substantial margin. And so that means that wages are moving up, which is a great thing, but they're moving up at a pace that is not consistent with 2% inflation. So there's a pathway for us to use our tools to try to moderate demand, still to a positive level, but not at the high level that it was at, for example, last year, and try to get demand and supply back into alignment in the labor market or close to it, so that there'll still be positive wage increases and healthy wage increases, but they'll be at a level that is more consistent with 2% inflation. Wages are a very important determiner of inflation over the longer term. So that's just an example of what our job is, and we think we can do that job. In the meantime, of course, everyone is looking for the supply side to heal more. We don't see much evidence of that yet, but I mean, I still think in the longer run, that has to be coming. There will be semiconductors and other things that are in short supply right now.
A lot of people, though, are skeptical that you can get inflation down to your 2% goal without a recession. What do you know that they don't?
I don't know anything that they don't. I mean, I would say there's no disagreement here, really. It is going to be a challenging task, and it's been made more challenging in the last couple of months because of global events. So it's challenging because unemployment is very low already, and because inflation is very high, and so. But I will just say,
guys, I'll be giving my commentary after this, so just stay put. There's a few things that I definitely want to discuss, but I want you guys to watch this. So
and get inflation back down, while also having a strong labor market. Doesn't mean that the unemployment rate needs to remain 3.6%, which is a very, very low rate, historically low. It's 1/10 above the 50-year low. You'd still have a quite a strong labor market if unemployment were to move up a few ticks. So I would say there are a number of plausible paths to having a soft, or as I've said, soft-ish landing. And our job isn't to handicap the odds; it is to try to achieve that. The last thing I'll say, though, is that achieving price stability, restoring price stability, is an unconditional need. It's something we have to do because really the economy doesn't work for workers or for businesses or for anybody without price stability. So it's the bedrock of the economy, really, and so that's something we need to do if we want to have the kind of labor market that we all want to have, which is one where there are tight labor market conditions and wages are moving up and people are changing jobs and opportunity is growing and all of that, but inflation is not high and eating up people's paychecks.
So, Chair Powell, I heard you refer to a softish landing, and I want to ask, what's the difference between a soft landing and a softish landing? Because if the pilot tells me, don't worry, we're going to have a softish landing, I don't know, I start to wonder what he's talking about.
Well, so you fly around, sometimes the landing is just perfect, right?
Yo, that was one of the lamest fucking jokes by this Justin Bieber looking motherfucker.
You don't even notice it, right? So, but in this, what does it mean in this setting? So I guess I would say this. We have to get inflation down to 2%. We've got to restore, our definition of price stability, and we will do that. It will be challenging to do that we have to slow growth to do that. That's the idea, is that growth has to move down. That's what has to happen for inflation to come down. We don't have precision tools. We can't say let's dial it into this exact level. we raise interest rates, that affects financial conditions, and financial conditions affect the economy. So there are a couple of steps there, and it is not in any way a surgically precision set of tools. So I would say there could, as I mentioned, there could be some pain involved to restoring price stability. But we think we can maintain a strong labor market, defined as a labor market where unemployment is low and wages are moving up and that kind of thing. It may not be the perfect labor market, but it will be a strong labor market.
So I'll move on from this subject, but I want to ask if there's a historical example that you could point to for what you're trying to achieve. Some people talk about the late 1990s, but even then the unemployment rate continued to drift lower after the Fed raised interest rates. So is this something that we have any recent historical experience with, what you're trying to do here?
Well, so you can look back to 1960. There have been 11 tightening cycles. And in none of those cycles do they look anything like the current cycle. We've never, I won't say never, but I'm not aware of a time when we've had 2 job openings for every unemployed person. And it's just an extraordinary, it's a once in a century pandemic, followed by historically large fiscal and monetary policy support, followed by a war in the middle of Europe between 2 commodity makers, followed by partial shutdown of China, a very large economy. That's the manufacturing center, one of the manufacturing centers of the world. So can you look in the history book and find that? No, you can't. And so I just think we're in a world of firsts. So I wouldn't say just because it's never happened before, it's impossible. I wouldn't say that. I would say that there are plausible paths, and that this will be challenging, but we'll do our best to achieve it. And in any case, we will achieve price stability.
So what are you looking to see, either in inflation or in financial conditions, that tells you that things are moving in your direction? Because it feels like there's a chance here that inflation does come down in the second half of the year, even though it'll still be above your target. But there's also a chance that the labor market tightens even more. And I wonder how you would, I know it's hard to respond to a hypothetical, but that doesn't seem like a crazy hypothetical to be considering right now. A situation where you do get improvement on inflation, but you do continue to overshoot an estimate of what might be considered a more stable employment situation.
Well, the main thing is to get inflation down. We all read, of course, everyone reads the inflation reports very carefully and looks for, details that look positive and that kind of thing. But truthfully, this is not a time for tremendously nuanced readings of inflation. We need to see inflation coming down in a convincing way. That's what we need to see. And until we see that, we're gonna keep going. We're not gonna assume that we've made it until we see that. And we're not seeing that right now. There are some promising signs. You can point to them. There are some signs that are not promising. But really, that's what we're looking to see. So, with the policy rate where it is, you don't need to.
Guys, why do you keep saying the market is dumping? The market is not dumping. It's intraday volatility. Traders are making a quick buck right now, which is what everybody should be doing. To be honest, if I wasn't on the stream, I'd be trading options too.
And make a judgment about where are we? Have we gotten as far as we need to get? And until we do, we'll keep going.
Now, a number of people have suggested to me that the one thing that might slow you down, or at least make this much more difficult, would be some kind of market cataclysm. And I wonder, in part, if that's why you're trying to be more transparent, not erratic, making sudden moves on your policy moves. But my question there is, where's your level of concern that financial stability and controlling inflation by raising interest rates, maybe a lot, might be fundamentally incompatible?
I swear to God, this guy asked the same question 100 different times. I'm going to end it soon, and I'll give you my commentary.
Where is your level of concern around that situation?
Let's hear about his level of concern.
I don't see that happening. I mean, we monitor a very broad range of financial conditions, and we're doing that now. We'll keep doing that. And, they're different cycles look different. Sometimes the tightening takes place in one market, sometimes in another, sometimes in credit spreads, sometimes in all of them. So we're watching them all, as a group. And of course, their volatility has been up a little bit, and that has some effect on liquidity in some markets. But Nonetheless, the markets are orderly, they're functioning. I think they're processing the way we're thinking, the way that the FOMC is thinking about policy pretty well. And I think that the idea, again, is to have financial conditions tighten to the point where growth will moderate and still be positive, but moderate to the point where supply and demand can get back in alignment and where we can get inflation back down to 2%. And I see that broadly working pretty well right now. Obviously, there are some volatile days and volatile markets, but so far, I see us as getting through this fairly well.
So this is the Future of Everything Festival. And in the time we have left, I want to look ahead at some of the issues on the horizon for the economy. Labor shortage. I wonder if you see that as something that might be a more persistent rather than just a cyclical feature in our economy. I mean, if you look at net immigration since 2017, because of policy reasons or the pandemic, it's been basically flat. Are labor shortages here to stay? And what would the implications of that be for the Fed?
I think there is a risk that we'll have a persistent imbalance between supply and demand in the labor market. And you put your finger on it. It's part of its population. There's the labor force. There's the labor force participation rate. But if the population is growing more slowly, there are going to be fewer workers, and that's a big part of the story. Really, in recent years, is immigration has been quite low. These are not tools or things that the Fed has or places where we seek to guide policy. But if you have a slower growing labor market, you're going to have a smaller economy, and you could be in a situation where these wage pressures remain longer. Of course, we'd love to see labor force participation come up, but I do think that I think that's a risk in the medium term, but it's really one for other policymakers to look after.
And related to that, economists have this concept called the natural rate of unemployment. The idea that when the economy is finally balanced, there's a level of unemployment that corresponds with stable inflation. And I went back and looked. When you joined the Board of Governors almost exactly 10 years ago, the participants once a quarter project where they think these things are. And so in 2012, you and most of your colleagues thought that level was between 5% and 6%. Now you and your colleagues have been writing down that it's somewhere between 3.5% and the low 4% area. But how much weight do you put on the prospect that the natural rate of unemployment, perhaps temporarily, perhaps not, has actually shifted higher and might be closer to where you and your colleagues thought it was 10 years ago?
Well, no, I think that may well be right. I think there was a tremendous amount of turbulence in the labor market, and so in theory, the sort of matching function that is the labor market could be disrupted. People are changing jobs at all-time record rates, and there's just a lot going on.
All right, so we've let them go on for 33 minutes already. So it's gotten kind of the conversation has gotten kind of stale because the interviewer is asking the same questions over and over again. And right now they're talking about the labor market, which the Fed cannot really control. So the only thing that the Fed can control is the supply side, the demand side of the supply-demand equation, right? They can only control demand. And what they're trying to do is obviously reduce demand, because that is the only way that we can get price reductions and price stability, because right now we have crazy price instability. There is one thing that I disagree with him about. So he basically said, when the interviewer asked him, going back, what are some of the things you can change? And he was saying that, hey, the inflation picture we thought was clear until October. And he's talking about October 2021. That is kind of concerning if the Fed was basically on their back foot until October 2021. And he said that that's when things drastically change. However, we've had supply chain bottlenecks for most of 2021. The chip shortage has been a topic of discussion. I know because we've done videos on it, and we're just a channel reporting casually on some of these things. Whereas obviously they have economists, full-time economists looking at the stuff full-time all day, every day. So, I don't think that he's being very honest by saying that, they thought that inflation was going to be something controllable until October 2021, when it was clear that it was going haywire. I think the signs were there before October. And then he said that if we didn't have the supply chain bottlenecks, we wouldn't have crazy inflation. Now, he might be right that we wouldn't have the extent of inflation that we do have now, right? But we still would have crazy inflation if you are printing trillions of dollars. And I'm not going to argue whether that was needed or not, during a time when the entire world was locked down. But when we had printing of trillions of dollars and the Fed basically kept interest rates at zero, and they were buying up record number of securities and treasuries, which, as you know, they have $9 trillion on their balance sheet. So, that isn't really, you can't just blame supply chain bottlenecks in isolation. There were so many different factors, some of which the Fed controlled, that led to inflation. Yes, you might not have, 8.5% year over year, but you still would have somewhat uncontrollable inflation. And the supply chain bottlenecks definitely add to the problem. They exacerbate the problem, right? So I definitely disagree with him on that. Let me know what you guys think in the chat there. Also, hit that thumbs up. There's so many watchers, but hit that thumbs up so that more people can find this stream. It's important, I think. And then when he talks about the labor market, the one concerning thing there is stagflation. So stagflation occurs when you have price instability and you have wage spirals, and with a slowing down economy. So when the GDP slows down, you still have price instability. And even on top of that, you have what's called a wage spiral, where a, lack of workers basically promotes, I guess, the wages going out of control, right? It's basically a supply demand imbalance in the labor market as well, where you don't have that many workers, so companies now have to pay more to attract workers. And when the wages spiral out of control, but you have a slowing down economy, that leads to stagflation as well. So that is definitely a danger, something to watch out for. As we talk about recession fears and the possibility of a recession, right? Let us hear if he has more to say, and we will then, if not, we will then not end this stream, but we will get into more commentary and analysis. There's a few things that I want to talk about. You have Morgan Stanley here saying that now there's a 27% chance of a recession. They had predicted 5% chance just a couple of months ago. And then you have the recession fears among a wave of investors saying that there is more cash now since 9/11. Obviously, 9/11 coincided with not only the terrorist attacks, but right before 9/11, we had the dot-com crash. So it was kind of a double whammy there. And we now apparently have more cash since 9/11, which is not a great sign. So a few things to get into. And then obviously Walmart, unexpectedly their earnings didn't go so well either. However, I do think that we will end the week green this week in the markets, only because statistically, and I shared this before, and I put this on my Twitter, but statistically, there have only been a few times that we've had 6 consecutive red weeks in the S&P 500, and every single time except for 1980 were we green a week later, right? So based on this model, there's a 93.33% chance that the next week, after 6 consecutive weeks of red, is going to be green. Now, this obviously is not a long-term trend, meaning it doesn't mean that the markets are going to be green from here on out. I do think that the catalysts remain mixed, and the market will therefore remain mixed and volatile. But as traders, we take advantage of that. So someone in the chat was asking, hey, can you give me a quick options play? Well, if you're in the group, then you already would have our options day trade watch list. These are the levels that I'm watching. This is from today on the Qs, the SPY, and then a few other of the larger ticker symbols that do pay out nicely when we see those breakouts either above resistance or below support. So if you are not in the private trading group and you would like to be, click the link in the description below. There is, I believe there are still coupons for 30% off or something off of the monthlies if you wanted to join. So yeah, if you want to know what to trade every day, well, we send this out every day so that you have the tickers and the levels pulled up on your radar. So let us get back to Jay Powell. Oh, actually, he's done. There you go. Let me get to your questions then. I'm going to pause this video. Let me get to your questions and see what questions you have, if there's anything that you want me to cover before going into market commentary. But you can see here the market basically digesting Jerome Powell's comments really well. You have the NASDAQ still up 2%, S&P 1.5 or 1.4, the Dow Jones up 0.83%, the Russell up 2.25%. There isn't really much that he said that was surprising. And then, as I said in yesterday's video, Bullard came out saying that he doesn't see a 75 basis point rate hike. He doesn't see a need for it. Obviously, he said that they will entertain it if need be, but they all say that, right? That is sort of an out that they give themselves. But in terms of projecting or telegraphing what is expected, it likely will not be 75 basis points. So we're going to be entertaining the 25 to 50 basis point territory, right? Let me get to your questions. And by the way, guys, do not, if you feel like donating money, don't give it to me. Just click the St. Jude's button down there. And thank you to those who have already donated. All right. They slide faster than they glide. Are you talking about the markets, Jonathan? Yeah, there's a saying that says that the markets take the elevator down and take the stairs up, meaning that moves down are usually way more violent than moves up, right? All right, let's see. Amateur hour in the chat. Yeah, the chat does get kind of crazy. He said the markets are orderly. Okay, any questions here or anything you want me to go over before I go over analysis on the chart? Blah, 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 blah. Everyone hit the thumbs up. Thank you, Gunmetal. What's going on, man? Interviewer is committed to ask questions so that Powell slips and market tanks. No, Sunil, this is not a Marvel movie. This is not how things it's not how things work. He's asking questions because he has, arguably the most important man in America on the hot seat. What else is he going to ask him? What fucking flavor of ice cream does he like? No, he's going to ask him questions about monetary policy, inflation, whatever. He's not nefariously doing this so that Powell slips and tanks the market so that he can get his orders in. You guys, sometimes some of you treat the markets like it's a Marvel movie with insane plots. I mean, it's fun to think of things like that, but unfortunately, it's not that complicated. All right. Let's see. Is this a bull trap? Catherine says, well, yes, it definitely could be. The thing is, you don't know you would actually call it a bear trap. A bull trap or a bear market rally. So you won't know until after the fact, right? But is it a bull trap? Yeah, I mean, it certainly could be. There isn't a reason for the markets to rally in a linear fashion, right? So I believe that there is more upside than downside from here, meaning that we could get more downside, but the downside is not going to be as violent as the downside we've already experienced. So what I mean by that is if the triple Qs are down already 30%, right? Is there a chance, is there a higher chance that the triple Qs have found a bottom versus them going down another 30%, meaning a total of 60% down? Yeah, I think we're closer to finding support than we are to tanking further by the same measure that we've already tanked. That's all I mean. So is this a bull trap? I mean, if for the short term, yeah, it could be. I do think the markets will end the week green just based off statistics, but that doesn't mean that we are in a decent place for a long-term uptrend. Not yet. Right. We do have the next round of earnings coming up in the summer. We have obviously the next CPI print that's coming up in June. We do have the next FOMC meeting that I believe is coming up in June as well. So there aren't really many catalysts. As I stated before, when the market is in this state of wanting to prove that companies are worth their weight, really, at the end of the day, all the market cares about are earnings. And if companies cannot show the ability to produce positive earnings, positive growth, positive guidance, then the market is fucked, especially if we are in this show and prove state, which we are currently in. High valuations have been getting killed. Those of you who came into investing pretty new and, were into... Those of you who came to investing pretty new, and sorry, I just realized I was looking at the 4-hour chart because I was like, hey, why are the triple Qs down, 0.04%, but it's actually up, but it's because I was looking at the 4-hour chart. So apologies. The triple Qs are still up 2%. But those of you who are new to investing, or came in at 2020 or 2021, know that the stocks that you likely were holding, most of the stocks that were touted on YouTube, unfortunately, those are called high beta stocks, and they were trading at insane valuations. Think of Rivian or QuantumScape or Lucid or, any one of these, Clover Health or Teladoc, Zoom, etc. The market basically tanked because when the hype is over, all the market wants to see are positive valuations, or I guess justified valuations. So at this point, when there are no other catalysts to go off of, the market is going to treat earnings very heavily. And if earnings were a very mixed bag, right, this last earnings season, and they were, then there aren't many catalysts between now and the next round of earnings to justify a violent uptrend. So, if you look at the NASDAQ or the S&P 500 and you look at the biggest companies here, I mean, Microsoft had expected earnings, so did Apple. And in Thinkorswim, the bigger the boxes, the more they are represented in that fund. So this is the NASDAQ 100. Google reported decent earnings. Facebook shit. Amazon shit. Tesla reported good earnings. So it was pretty much a mixed bag. And the earnings season, I can't say was very stellar. And more importantly, guidance was not positive because of obviously the cost of money is going up because interest rates are going up. Future earnings are discounted, right? They're discounted heavier because now the cost of money is higher as interest rates go up. And yeah, you have obviously the COVID lockdowns in China, the supply chain bottlenecks. So future guidance was not great. And that's not really surprising. So we have to wait until the next round of earnings to see what the outlook is and if the outlook changed. But let me get to your questions. Where are your questions? All right, let's see. He looks like Tucker Carlson on Rage Mode all the time. Oh yeah, that host did remind me of like a mix between Justin Bieber and Tucker Carlson. That's for sure. Shop going back up, blah blah. Y'all just listened to someone's full portfolio. You just listed someone's full portfolio. Oh, you're talking about the high beta stocks? Unfortunately, yes. You're probably right. Are you focusing on tech buys or more conservative stocks? Look, tech stocks run the world. They are the highest market cap stocks right now, right? Out of the $1 trillion companies. So we have what, $5 trillion companies? Microsoft, Apple, Google, Amazon, Tesla. Those are the 5 American $1 trillion companies. Obviously, you have international ones like Aramco and whatever, but we're not going to get into that. Those are the $5 trillion companies. And Palantir. No, I'm just kidding. Those are the $5 trillion companies, and 4 of them are tech stocks. And a lot of people do lump in Tesla in the tech sector because they are more than just a car company. Obviously, they have the autonomous driving, etc. So, yeah, tech companies are the conservative companies right now because they're the ones that actually bring in revenue. They're profitable. They have insane amounts of cash flow. Their balance sheets are good. And they grow usually at a rate that outpaces inflation. It's just that right now for this time period, inflation is insane, right? So I am focusing on tech companies somewhat, not solely. If you guys are part of the private trading group, you know that we did make buys on here. I'll just share it with you. Why not? but we did make buys on tech companies as well. I sold cash secure puts on Microsoft, Apple, QQQ, Tesla, and then also on the watch list, there are a few stocks that I was looking at. Some are not tech stocks, right? SPY-V is a value ETF. So, during times of recession, during economic slowdowns, value stocks tend to outperform growth stocks. So I want to be exposed somewhat to value stocks as well, which is why I picked SPY-V. And then obviously there's Berkshire Hathaway here. I'm looking at Disney, and I'm looking at XLF, which is the ETF that deals with the financial sector of the S&P 500. I think banks have been beaten up quite a bit, especially with the inverted yield curves and whatnot. So, banks are at a discount. Banks tend to do well during rate hike cycles. And right now they're discounted enough for me to start nibbling on, right? So I'm looking at those things. Now, again, it's going to be a rocky ride. We're likely not going to see a shot back up to all-time high. The only thing that will do that, and I've talked about this before, is any sort of unexpected events. Like, say, for instance, tomorrow, the war between Russia and Ukraine ends, like completely ends, either a ceasefire or something, right? But say that news comes out. What do you think is going to happen to the markets? The markets are now going to price in all of that exuberance and the fact that, we're going to get a relief of supply chain bottlenecks, right? Because that is the Russia-Ukraine situation has a major impact, especially on the European markets. And since Europe is the number one partner of the U.S., it also has an effect on the U.S. economy, right? So if the Russia-Ukraine war unexpectedly goes away or ends overnight, yeah, you will see a huge rally. Otherwise, other than those black swan, white swan events, right? I personally think that it is going to be a rocky road until the next round of earnings, or if the next CPI print comes in and the CPI print shows that now, instead of, because the last one that came out, we were at 8.5%, that dropped to 8.3%, obviously not great. But if the next one comes in and say we're at 6.5% miraculously or something, and it looks like the inflation picture is getting better, then I think you will start to see some optimism built, some more consistent optimism built into the market. Otherwise, I do think these are good levels to start nibbling it at, but I don't think it's going to be a comfortable ride. It is one of these situations where you look at companies and ETFs that you think are at a major discount for your portfolio for the long term, right? We're talking 10, 20, 30-year horizons here. So, if you are looking at your portfolio every day, it's still, in my view, not going to be fun in the short term. So hopefully you guys can get that sort of nuance, right? Let me get, wow, Naked HD XYZ. All right, man. I'm going to, let's see, hide user on this channel. That is a bunch of spam. All right, there we go. Let's see. Let me get to your questions. Oh, man, don't make me feel bad about Palantir. Randy King Singh says, I mean, I don't know. Z not being a pal to Palantir. No, guys, it's not bad to speculate on the future of companies and to invest in, the future of companies and try and find a unicorn in the sea of stocks. It's just that, putting half of your portfolio in Palantir just based off of YouTube videos or something is one of the stupidest things ever. And, if you've done that, don't feel bad. We've all made mistakes in the market. It's just, the onus is more on people who are pushing that narrative. Like, oh, and if it drops to 6, I'm buying even more. And if it drops to 3, I'm buying even more. If it drops to 1, I'm buying even more. Like, that incessant type of buying in a very cult-like fashion, that's not investing. I don't care what anybody says. That's, and some of those same people make fun of Cathie Wood, about her digging her heels in, saying, oh, we have a 5-year time horizon on Teladoc and Zoom and Roku and all this shit. Some of those same people have fucking 50% Palantir in their portfolio, right? And I just think that if you make content, you have somewhat of a responsibility to push a, I would say, honest narrative. It doesn't mean you're not going to make mistakes. It doesn't mean anyone should look at YouTube videos as a way to build your portfolio. As a matter of fact, probably the contrary. I'm just saying that, that, putting 50% of your portfolio in a high beta stock, the chances of a high beta stock becoming a unicorn is very low. So what do you think the chances of your portfolio popping are, right? It could happen, sure. If you put 100% of your portfolio on Amazon back in 2002, you would be fucking Jeff Bezos right now, right? You'd be Jeff Bezos light. But again, the chance of that happening, of you picking the one company that's going to make life-changing amounts of money for you, are very low. So what are the chances of your portfolio rising, right? It's all about probability. So that is why I'm a big believer in portfolio distribution. If you believe in a company and you say this company is going to be a unicorn, it does not mean that you then size your portfolio with a huge bet. You might as well just play the lottery, right? You are still better off allocating your portfolio to quality companies that have shown and proven, and using a small amount of your portfolio on this bet that you think is going to be life-changing. Hopefully that makes sense. Anyway, rant over. Let's see. Ranjit, 100% agree. I appreciate you. If you have your portfolio into Palantir, double down and put 100% in. In a 25K portfolio, how much you must address for each stock? Rui says. Is it Rui? Asuncao? Are you Brazilian? That sounds like a Portuguese name. In a 25K portfolio, how much you must address for each stock? It doesn't matter the amount, right? You were talking about a percentage. So in general, traditionally, you don't go more than 10% into a stock, right? Into a single stock. It doesn't matter if you have a 25K portfolio or 250K portfolio, right? Zuni B, bring the truth, please. Yeah, I mean, you're not gonna get a lie out of me. I'll tell you that much, right? You might not agree with me, but you're not gonna get a lie out of me. Back to orthodoxy. What's up, Z? Hope you are well and blessed. You too, brother. You too, or sister. You too. Market outlook for summer: rally or rocky road? I think it's going to be a rocky road, as I said. I'd only be worried if there was a swan song event. Shaft. Yeah, I feel this is a trap. Just the volatility alone sketchy. Well, let us take a look at the volatility. The VIX is actually down 7% almost today. Now, I won't be comfortable in saying that, the rockiness is over until we get a VIX below 20. So for most of 2021, the VIX was actually 20 or below. That was the normal range post-COVID during a risk-on environment. In a risk-off environment, we've actually had the VIX almost reach 40, and that wasn't that long ago. Let's see. Let's look at the VIX. And I did a video talking about if you just use what the fuck is this? If you just use the VIX as a way to invest, and all you did was buy when the VIX was, 40 and above, your portfolio would likely look pretty good for the long term. So yeah, the VIX just just 2 weeks ago was 37, right? And then in February, we did hit almost 40, but it hasn't really been below 20 for most of 2022. Most of 2022, we've been above 30. And, until we get below that and trade below that in a comfortable range, like you saw in March, we did that, right? And March is when we had that pop in the stock market where everyone was like, oh, the bear market is over. This is going to be back to all-time highs. But then obviously we got earnings, and then the picture quickly changed. But yeah, I mean, the VIX is definitely trading in a more risk-on way, meaning investors now are more willing to take more risks than they were just a couple of weeks ago. So you have to go all the way back to March to see a VIX this low. But it is at the 100-day moving average. So let's see. If we get the VIX dropping below 20, then I think you see the market fly in the short term, right? But again, as I said in the start of the week, I do think that we will end the week green just based off statistical data here, right? It's very getting over 6 weeks of red in the S&P 500 is very rare. If you look here, the last time it happened was 2011, and the last time before that was 2008, right? So it does not happen that often. So, we did have 6 weeks of red going all the way back to April 4th. And now we will likely see some relief this week. It doesn't mean that this is the bottom, but yeah. Even back during COVID times, we didn't have 6 weeks of red. We had 5, and then that was the bottom, right? So 6 weeks of red, more than 6 weeks of red is very rare in the U.S. stock market, unless you have a 2008-like scenario. I have already 6 wives, no place for more. Seems like a very random comment. I like these random comments. I have no idea why you guys write them out sometimes. All right. Been loading TQQ, Apple, NVIDIA. What's your bench press, bro? Travis asks. Travis, what do you think it is? I don't know. I haven't maxed out in a long time. I did do an 80-mile bike ride this last weekend around the entirety of Lake Tahoe, which is crazy because I don't bike at all. It was my first bike ride. I don't know what my max bench press is. RJ, what's your weight, homie? Why are all of you obsessed with these physical attributes? My weight, I teeter between 170 and 175. That's my walking around weight. That's what I feel comfortable in. Yeah. I don't know. Why? Did you want to box? Melanie. What's up, bro? Melanie. That's a pretty progressive way for someone named Melanie to address another human being. What's up, bro? What's up, Melanie? Dr. Jennifer Berry. How many red weeks in 2000? Dr. Jennifer Berry, you want me to go off of memory? Are you saying that I'm old? You want me to just go offhand memory? That is the year that I graduated college, actually, which is funny. Let's see. Year 2000. How many red weeks? Yeah, I mean, even then, actually, let me go back to this data because it's easier to read. So we had 6 red weeks, October 13th. And then even then, in the year 2000, fucking insane level crash. Even then, we had the 7th week was green. The 8th week was green. And it wasn't until the 9th week and beyond that we started dropping again, right? 2001, we had another 6 weeks of red. The 7th week was green. The 8th week was red. 9th and 10th week were green. October 2002, we also had, so yeah, I mean, the early 2000s that was a period of high volatility. Obviously, we had the dot-com crash, and then 9/11 happened. So not a great few years for the U.S., right? But then, yeah, it wasn't until after 2002, then we had 2 years before we saw another period where the S&P had 6 weeks of red, 4 years from that, 3 years from that, and then it wasn't until even COVID didn't yield 6 weeks of red, right? It wasn't until 11 years later that we had now another period of 6 weeks of red. So it is fairly rare, and usually it has coincided with some of the worst recessions, and then obviously events like the 9/11 terrorist attacks. So yeah, hopefully that answers your question, Dr. Jennifer Berry. What are you doctoring, by the way? Put that down there. Let me know. Melanie, anybody that asks a person for their max bench doesn't lift. Yeah, you should do more live streams. Bench stream. Yeah, stock going up now. Lake Michigan. This guy is so delusional. Who are you talking about? Lake Michigan lover. I need to know. Oh, you're talking about all the people asking me about the bench press? Bloodlink, where's the merch? We are working on a site right now. Chance Thao, thoughts on Michael Burry's Apple short? I think Michael Burry didn't short Apple now. It was revealed that he shorted Apple because he has to file, I think, 13 filings because he runs a public fund. So he actually shorted Apple. This is, by the way, a bullish engulfing candle on the SPY on the weekly. So let's see if this is a short-term bottom and we get a rally to like the 420 mark on the SPY. Apple. So I think he shorted Apple, and correct me if I'm wrong if you guys know the story, but I think he shorted Apple March or April. So in the 170s, 180s. That's when he shorted Apple. Yeah, I mean, what do I think about it? Obviously, it was hella smart, right? He saw that the valuation was getting back to double top scenario during a time of economic slowdown after this, bear market rally or this bull trap here. I think it was a very smart play. Yeah. What else am I going to say about it? I don't know if he closed it. I don't think anybody knows if he closed it. I think you're going to have to wait until the next 13F filing to know if it's still open, right? But yeah, market bounced right back and trading. I mean, the market wasn't down. Like, did you guys not look at the market when it opened? I mean, we were pretty much green most of the day. Where's your hometown traveling trader? Los Angeles, California. I graduated in 01. I'm old as fuck. Yeah. How many countries did you visit? I don't know, 40, 50? A lot. I don't know. I'll have to look at my passport. Where's the market is tanking crowd now? Shaft. They've obviously gone to lunch, so they will be back. Oh, shit. It is power hour. I better... Dr. Jennifer Berry says, emergency medicine. Hats off to you, Dr. Jennifer Berry. Proud of you. And thank you for joining the stream. And thank you for your question. Hopefully I answered it. All right. I'm going to hide this user again. All right. Playing earnings options. That's a dangerous game. Well, we actually played Home Depot. We did a double calendar on Home Depot that ended pretty well. What are your thoughts about Shiba Inu? Shitcoin. If you know how to read a chart, you can make money. Shahid Khan, I just told you guys the bottom's in. Z, could you go through a Fibonacci setup? These dudes are going off course with these do you live questions. I did a whole Fibonacci thing the last time I went live, but yeah, if really quick, if you're measuring this downtrend, what you're going to be doing, you're going to be measuring this downtrend against a low and a high, right? And this is, I'm not going to say subjective, but you can have multiple Fibonacci's on one chart because you can essentially use a low and a high from different time periods. So if I wanted to measure, for instance, the COVID low on Apple, here, let's do the weekly. If I wanted to measure the COVID low on Apple and use that as my low, whoops. Here, I'll just draw like this. Use this as my low and use this as my high, right? This is my swing low, which is a COVID bottom. This is my high, which is the after COVID top. Then this is what the Fibonacci will look like. And I'm basically measuring this downtrend on Apple, this most recent downtrend, right? And it looks like we are... the 0.382 level based on the Fibonacci would be the next level that we were looking at. Now, you can make the case that this last week hit very close to 0.382. So it doesn't have to be exact, but you could have set up purchases or made a long-term buy on Apple based on this Fibonacci level, saying that at the 0.382, I'll buy some Apple. If we get to the 0.618, which I personally don't think Apple will get that low, but this is my next buy point. So you use the Fibonacci as another tool to identify support and resistance, but that's essentially how you would do it. All right, what are your thoughts about XRP? Another shit coin. If you can trade it, great. I bought a boatload of physical metal this year. Cool. Hopefully you have a place to store it. All right. Think of the children. Yes. Donate to St. Jude's, please, guys. All right. I got it. Thanks, Z. Blah, blah. You playing AMC options? Maybe. Is it a good time to put 2% of portfolio in small cap stocks? Up to you. At least you're thinking with a conservative amount and not YOLOing your portfolio in these bullshit stocks. All right. So appreciate you guys for joining. Hopefully you guys got something out of it. Hopefully you understood what Jerome Powell was saying. Again, in summary, Jerome Powell basically didn't say much in terms of unexpected terms of unexpected news. He basically just said that the Fed is going to do what they have to do. 75 basis point rate hike is not off the table, but unlikely. And yeah, that there likely will be a supply-demand imbalance in the labor market, which is not going to be good for price instability. So that is it. I will see most of you guys who are on this. I'll see you guys on the Discord. Do me a favor, leave a thumbs up on your way out, please, so that people can find the next live stream. For those of you that are in the Discord, I will be sending out my trades. If you're not in the Discord, sign up. Link is in the description below. You will get 30% or so off of your subscription if you sign up now. I don't know how long those coupons will last for, or if there even are any left, but check. All right. That is it. Talk to you guys soon. Peace. No, stay safe.